Welcome to Finance Buzz Friday, your go-to podcast for the latest insights and updates from the financial services world. Today, we're diving deep into how recent developments in sustainable finance could shake up the entire industry, particularly here in the UK. Get this, BNP Paribas Asset Management just announced they're excluding new oil and gas bonds from their investments, effective immediately.
Yeah, it's a huge move, especially considering they manage a staggering $1.8 billion in oil and gas equities. This isn't just about integrating ESG factors anymore. This is a direct challenge to the traditional financing models of the energy sector. And it could have significant ripple effects throughout the entire financial services industry.
It really just feels like a line in the sand, doesn't it?
Mm-hmm.
What makes this different from the typical sustainable investing we've seen before?
Think of it this way. Previously, many funds might have screened out companies with particularly poor environmental practices. This is a step further. By refusing to buy any new oil and gas bonds, BNP Paribas is essentially saying they don't see those as viable investments in a future that's rapidly decarbonizing.
Wow. So how do you think this will play out for the UK financial sector specifically? After all, London is a global finance hub.
Exactly. The UK can't afford to ignore this shift. Investors are watching closely, and they're increasingly demanding transparency and action on climate commitments. Any financial institution that lags behind risks losing out, both in terms of attracting investment and managing their own risk exposure. This isn't just about ethics anymore. It's about staying competitive.
So true. And speaking of competitiveness, the COP29 Climate Summit just wrapped up. And while there were mixed results, the push for a $300 billion climate finance target and discussions around regulating carbon markets send a strong signal about the future direction of the financial world.
Absolutely. One of the key takeaways from COP29 is that there's growing pressure on financial institutions to play a leading role in the transition to a low-carbon economy. Remember, some countries, including Saudi Arabia, actively lobbied against stronger commitments to shift away from fossil fuels. That just underscores the scale of the economic transformation we're talking about.
It's mind-boggling when you think about it. We're essentially talking about rewiring the entire global financial system. But how does this translate into concrete actions? What are investors specifically looking for?
One great example is Aviva Investors. They're a major asset manager, and they're calling for clear policies and what they call investment-ready projects in national climate plans. Essentially, they're saying, if you want our money to help you transition to a sustainable economy, you need to present us with well-structured, transparent plans that demonstrate how those projects will be both environmentally and financially viable.
That makes a lot of sense. So it's not just about good intentions anymore. Investors are demanding a level of detail and planning that hasn't always been present in the past. But what happens to traditional energy companies in this scenario? Are they doomed?
Well, it's certainly a challenging landscape for them. The transition away from fossil fuels is complex and requires massive investment. There's also the issue of what's known as transition risk, the financial risks associated with moving to a low-carbon economy.
Okay, let's unpack that. What exactly does transition risk mean for companies in the UK?
In simple terms, it means that companies heavily reliant on fossil fuels face increasing financial risks as the world moves towards cleaner energy sources. These risks can manifest in many ways. For example, stricter environmental regulations could increase operating costs, or shifts in consumer demand can make their products less desirable.
So we could potentially see a scenario where companies struggle to secure financing because investors see them as too risky. Is that what you're saying?
Precisely. We're already seeing this play out, remember? The energy crisis highlighted how fragile the current system is. And even companies initially seen as leaders in sustainability, like BP and Unilever, are facing criticism for scaling back their green initiatives in response to economic pressures.
No, what you're saying is that this is more than just a trend. It's a fundamental shift in how the entire financial system operates.
Yes, and it's happening right now. The question is, how quickly can companies and financial institutions adapt to this new reality? It is indeed a fundamental shift. And this transition risk has huge implications for the financial services industry, especially in the UK. For lenders, it means reassessing the creditworthiness of companies in high-emission sectors. For insurers, it's about accurately pricing the risks associated with things like extreme weather events and climate litigation.
So it's not just about avoiding investments in certain companies or sectors. It's about reevaluating the entire risk landscape.
Precisely. Take the example of a bank lending money to a real estate developer. In the past, the bank might have focused primarily on the developer's financial history and the value of the property. Now, they need to consider things like the building's energy efficiency, its exposure to climate-related risks, like flooding, and even the sustainability of the materials used in construction.
Like the whole concept of risk has been redefined. And what about the average investor? How can they make sense of this new reality and make informed decisions?
That's a great question. First and foremost, it's about asking the right questions. When choosing a financial institution or investment product, don't be afraid to ask how they're incorporating sustainability into their decision-making processes. Look for companies that are transparent about their climate-related risks and opportunities and have clear plans for managing them.
So it's about looking beyond the traditional financial metrics and really digging into the company's sustainability practices.
Exactly. Don't fall for greenwashing, where companies make vague claims about being eco-friendly without any real substance. Look for verifiable data, concrete targets, and a track record of action.
That makes sense. It seems like there's a lot of information out there, but not all of it is equally reliable. Are there any resources or frameworks that investors can use to guide their decision-making?
There are some excellent resources available. For instance, the Task Force on Climate-Related Financial Disclosures, or TCFD, provides a framework for companies to disclose their climate-related risks and opportunities in a standardized way. This can help investors compare companies and make more informed choices.
So the TCFD can help cut through the noise and provide some much-needed clarity.
Absolutely. It's not just about reporting, though. It's about action. Investors should look for companies that are integrating climate considerations into their core business strategies, not just treating sustainability as a side project.
It seems like this shift towards sustainable finance is touching every corner of the financial services industry. Do you see this trend continuing to gain momentum?
I absolutely do. In fact, I think we're just scratching the surface of what's possible. As more investors demand action and regulators step up their efforts, we're likely to see a wave of innovation in the financial sector, with new products, services, and business models emerging to meet the demands of a low-carbon economy.
It's exciting to think about the potential for positive change. But let's be realistic. The transition to a sustainable financial system isn't going to be easy, right? There will be challenges and pushback along the way.
Of course, there will be resistance from those who benefit from the status quo, and there will be difficult choices to be made. The recent energy crisis underscored the complexities involved in balancing the need for a rapid energy transition with ensuring energy security and affordability.
So, there's a real need for thoughtful leadership and collaboration across all sectors of the economy.
Exactly. We need governments setting clear policies and providing incentives, businesses innovating and adapting their operations, and investors holding everyone accountable.
It sounds like we're talking about a systemic transformation, not just a tweak here and there. What does that mean for the future of finance as a whole?
Well, I think it means that the very definition of value is changing. In the past, financial success was often measured solely in terms of profits and shareholder returns. Now, we're starting to recognize that environmental and social factors are equally important.
So it's not just about making money anymore. It's about making money in a way that's responsible and sustainable.
Precisely. We're moving away from the old model of shareholder primacy, where the sole focus was on maximizing profits for shareholders, regardless of the broader impact.
Toward a more holistic view of stakeholder capitalism.
Exactly. This approach recognizes that companies have a responsibility not just to their shareholders, but also to their employees, customers, communities, and the environment.
It's fascinating to see how this concept of stakeholder capitalism is becoming increasingly mainstream, even within the financial services industry, which has traditionally been seen as very profit-driven.
It's a sign of the times. Investors are realizing that companies that prioritize sustainability are often better positioned for long-term success. They're more resilient to risks, more innovative, and better able to attract and retain talent.
So it's not a zero-sum game. Companies can do well by doing good.
That's the idea. Of course, there are challenges in measuring and quantifying these non-financial factors, but we're seeing significant progress in this area, with new metrics and frameworks being developed to assess a company's performance on environmental, social, and governance (ESG) issues.
That makes a lot of sense. But how does this translate into concrete action for investors? What should they be looking for when evaluating companies or investment opportunities?
Here's the thing. It's not just about divesting from fossil fuels or investing in renewable energy. It's about looking at the bigger picture. How is a company managing its carbon footprint? How is it treating its employees? Is it contributing to the communities where it operates? These are all factors that can impact a company's long-term sustainability and profitability.
It's about looking beyond the short-term bottom line and considering the broader impact of a company's actions.
Exactly. And it's about using your investment power to support companies that are aligned with your values. Every dollar you invest is a vote for the kind of world you want to see.
So it's about aligning your financial decisions with your personal values and using your money to make a positive impact.
Precisely. And that's where the real power of sustainable finance lies. It gives individuals the opportunity to be part of the solution, not just the problem.
It's incredible to think about the sheer scale of this shift and how it will affect the financial services industry in the UK and around the world. It's not just about tweaking a few investment strategies. It's about a fundamental restructuring of how we think about value, risk, and the role of finance in society.
I think what's really exciting is that this isn't just a trend limited to a few niche investors. We're seeing this shift happening across the board, from pension funds and insurance companies to individual investors who are increasingly demanding that their money be invested responsibly.
It's like there's a growing awareness that our financial decisions have real-world consequences and that we can use our money to shape a more sustainable future. But how do we actually make that happen? What are the concrete steps that need to be taken?
Well, first and foremost, we need greater transparency. Investors need clear, reliable information about how companies are managing their environmental and social impacts. We've talked about the TCFD, which is a great step in that direction. But we need more standardized metrics and reporting frameworks that allow for apples-to-apples comparisons.
That makes a lot of sense. It's hard to make informed decisions if you're constantly wading through a sea of conflicting data and greenwashing.
Yeah.
But transparency is just the first step, right?
Absolutely. We also need to see a shift in investment priorities. For too long, capital has flowed freely into unsustainable industries, often fueled by government subsidies and a lack of accountability for environmental damage. We need to redirect those financial flows towards solutions, towards companies that are building a more sustainable future.
So we need to create a system that rewards companies for their positive impact, not just their profits.
Exactly. And that means thinking about the role of government as well. Governments can play a huge role in shaping the financial landscape through policies and regulations that incentivize sustainable investments and discourage unsustainable practices. We're already seeing some movement in that direction with things like carbon pricing and green bonds. But we need to go much further.
It sounds like we're talking about a complete overhaul of the financial system, not just a few minor adjustments.
That's true to a certain extent. But I think it's important to remember that this isn't about tearing down the existing system and starting from scratch. It's about evolution, about adapting the tools and institutions we already have to meet the challenges of the 21st century.
So it's about building on what we have, but with a new set of values and priorities.
That's a great way to put it. We need to move away from the short-term thinking that has dominated finance for so long and embrace a longer-term perspective that takes into account the well-being of future generations.
And that's where the real challenge lies, right? Changing mindsets, shifting priorities, and building a system that's truly aligned with the sustainable future.
Absolutely. But I'm optimistic. The momentum is building. Investors, consumers, and even regulators are demanding change. And the financial services industry is starting to respond.
It's been a fascinating deep dive into the world of sustainable finance. We've seen how recent developments are creating a sense of urgency, but also a sense of opportunity. It's clear that we're at a pivotal moment, and that the decisions made by investors, businesses, and governments in the coming years will have a profound impact on the shape of our world.
I completely agree. And the most important takeaway is this. This isn't just about numbers on a balance sheet. This is about our collective future. By embracing the principles of sustainable finance, we can create a financial system that works for everyone, not just a select few, and that ensures a healthy planet for generations to come.